Welcome to IAS Project. We are continuing with the videos on Indian economy for UPSC Civil Services Examination. GDP at factor cost is useful to see how competitive market forces are as well as how productive factors of production are. We have already discussed this again in previous video. We know factor cost is nothing but compensation to employees plus operating surplus or mixed income plus consumption of fixed capital. This do not have any kind of taxes. So whatever is the money that is going towards factors of production during a production process is counted as a factor cost. So if factor cost GDP is less in, let's say, country 1 and it is more in, let's say, country 2, it means that factors of production are cheaper here. So it is always better to manufacture goods here. So GDP at factor cost simply shows that how productive the factors of production are. That means if they are highly productive, they will take less money and manufacture the product. Also, it shows how competitive market forces are, because when market forces are very competitive, it means that you will have labor cheaply available as well as consumption of fixed capital is very less and profits are very less. So operating surplus or mixed income is very less. They are ready to make or manufacture goods and services at very low profits. So GDP at factor cost shows competitiveness of market forces as well as productivity of factors of production. Also, it also tells us about the distortionary nature of indirect taxes. We know that if we compare market prices and factor cost, we know that the difference is nothing but the taxes. So if factor cost is low at a place and market price is high, this means that although factor cost is low, taxes are very high, therefore the market prices are very high. So we can compare market prices GDP and factor cost GDP and we can see how taxes are burdening the economy. Let's see the next point. GDP GVA link gives us information on net direct taxes. We already know GVA means nothing but GVA at basic prices. GDP means GDP at market prices. GDP minus GVA, we are ending with market prices minus basic prices. We also know the difference between market prices and basic prices is nothing but net indirect taxes. So GDP and GVA link gives us information on net indirect taxes. Ideally, GVA and GDP should grow at same rates. However, there may arise certain situations. Let's understand this with example. GVA and GDP, let's say for 2 years are given, year 1 and the year 2. So the first year GVA or GVA at basic prices is 100 and in the second year it is 110. Let's say GDP at market prices for the first year is 120 and for the next year is 130. So what this means is the net indirect taxes here are 20 because GDP minus GVA will give us net indirect taxes. Here GDP minus GVA is again 20. So in the first year the GVA was 100 and in the second year it was 110. So there is an increase in GVA. Similarly, there is an increase in GDP also. However, the taxes have remained same. This means that two cases are possible. Either tax buoyancy is less than 1 or tax evasion is being done. This is also possible if in a third case, for example, in year 3, let's say GVA has increased to 120 and GDP has increased to 135. So the indirect taxes here are 135 minus 120, which is 50. In this case, there is an increase in GVA as well as increase in GDP, but there is a decrease in indirect taxes. This again shows that tax buoyancy is less than 1 or tax evasion is being done. Let's see what these two terms are. Let's look at what tax buoyancy is. The definition is given here, but let's try to understand the concept first and then read the definition. Tax buoyancy is simply percentage change in tax revenue divided by percentage change in tax base. Tax base for our purpose can be simply assumed as national income or GDP. So tax buoyancy is nothing but percentage change in tax revenue divided by percentage change in GDP. For example, GDP is growing at 10%, but taxes are growing only at 9%. So this means that tax buoyancy is 0.9. It is less than 1. What we understand by this is the rate at which the national income or GDP is growing, the tax revenue is not growing at that same rate. Okay. For example, if tax revenue is growing at, let's say, 11% and GDP is growing at 10%, this means that tax buoyancy is 1.1. So this shows us that tax revenues are increasing at a rate higher than the rate of national income increase. So obviously, tax buoyancy of greater than 1 is beneficial to the government because they will be getting higher taxes compared to the increase in the national income. So let's look at the definition of tax buoyancy for the purposes of mains exam. Tax buoyancy measures the total response of tax revenue in terms of percentage, both to changes in national income as well as to discretionary changes in tax policies over time. So the second point here means that tax buoyancy can also be calculated not only at the entire national level or national tax revenue level, but also can be calculated for a particular kind of tax. For example, for GST, what is the tax buoyancy? For example, if government is bringing a new policy on GST, are the GST taxes collection going to increase or decrease? It can be calculated for income tax also. What about the tax buoyancy of income tax? For example, government is changing the income tax policy. It is reducing the slabs or increasing the slabs. Then what is going to happen to the income tax? Are the collections going to increase or decrease? So tax buoyancy gives the information for that also. Tax buoyancy greater than 1 means that tax collections will be higher compared to the increase in the national income. So a tax is said to be buoyant when the tax buoyancy is greater than 1. We also have a concept of tax elasticity. Let's learn what tax elasticity is. Tax elasticity simply means that the changes in tax revenue in response to changes in tax rate, considering other parameters have not changed. Tax elasticity is generally given as slope on Laffer curve. Let's see what Laffer curve is. Laffer curve is nothing but on x-axis we have tax rates, on y-axis we have tax revenue. This is again an inverted U-shaped curve. Basically it means that when tax rate is 0, it means that government will not get any kind of tax revenue. Again, when tax rate is, let's say, 100%, when tax rate is 100%, it means that government will get the entire income. So we are talking about income taxes. Income tax is 100% means that government will be taking your entire salary. You will have 0 rupees to spend. You will have 0 rupees to spend means that you will not be doing any kind of economic activity. The same is for companies also. If government is taxing companies at 100%, companies will not have any money to do business. So ultimately, government will not have any money of companies to tax upon. So a tax rate at 0% or 100% simply means that tax revenue is 0. So when we increase from 0%, we will certainly meet a point where tax revenue is optimal. This means that if government applies this much percentage, let's say 15% tax rate, then government will receive the optimal or the maximum tax revenue. So governments generally try to apply tax in this area. Government does not try to tax in this rate or in this rate, because even though government increases tax rates, it is going to decrease the tax revenue. Here also, if government want to decrease the tax rate, it is going to decrease the tax revenue. Therefore, governments always choose to apply optimal tax rate so that they can maximize their tax revenue. So Laffer curve gives this. Now, what about the slope? We know slope is nothing but dy by dx for people who can understand mathematics. So slope is nothing but change in tax revenue on change in tax rate. This is nothing but the slope. Slope of Laffer curve is simply change in tax revenue divided by change in tax rate. This is nothing but tax elasticity. So slope on the Laffer curve gives us tax elasticity. Ideally, GVA and GDP should grow at same rates. If they are not growing at same rates, then there are two situations possible. One is tax buoyancy is less than 1, or tax evasion is taking place. Now let's understand what is the meaning of tax evasion. We basically have three words here. One is tax evasion. Tax evasion is a way of concealing taxable income or information from the government. So ultimately you are concealing some income or information from the government and you are not paying the required amount of taxes. Tax evasion is illegal. Then what is tax avoidance? Tax avoidance simply means that you are using legally available methods to reduce taxable income and therefore reduce the payment of taxes to the government. Tax avoidance is legal, but tax evasion is illegal. What are tax shelters? Tax shelters are simply those legal provisions in a country's taxation laws to reduce taxable income. For example, you know 80C section of income tax, where you can pay a premium for life insurance. So premium for life insurance, whatever you are paying, is deductible from your taxable income under section 80C. So this provision simply is called as a tax shelter. Additionally, you can contribute towards national pension scheme also. National pension scheme, if you are contributing, that amount is reduced from your taxable income. So national pension scheme is also a tax shelter. So there are two conditions possible. One is tax evasion or tax buoyancy if GDP and GVR are not growing at the same rate. GDP, we must note, includes production by all producers within the country. As we have discussed, within India, whatever production is being done by Maruti Suzuki and whatever being done by Mahindra and whatever is being done by Audi, all these are included in GDP of India, although Audi may be a foreign company. GDP PPP is used by IMF for ranking global economies. What is PPP? PPP is nothing but purchasing power parity. Generally, if we see exchange rates of currencies, there are two kinds of exchange rates. One is market exchange rate. Market exchange rate simply means that you go to the market and supply whatever currency you are supplying, and whatever is written which the market is offering to you, it is called as market exchange rate. For example, 1 USD may be somewhere around 70 or 80 Indian rupees. So this is called as market exchange rate. This means that if you go to the market and if you have 1 USD, you will get somewhere around this much INR. Or if you have this much INR, you can exchange it for 1 US dollar. We also have a second type of exchange rate, which is called as purchasing power parity rate. Purchasing power parity is a metric whereby exchange rates between two countries are considered on a basis of specific basket of goods. Let's try to understand this. Let's try to understand this with the example of USA as well as India. In USA, the currency is US dollar. In India, it is Indian rupee. We know this much. Now, let's consider a basket of goods in USA. Let this basket include goods like some food, water for drinking, let's say electricity, petroleum. These are all examples for certain items in a basket of goods. Remember, these are only examples. Actual basket might be different. Generally, 3000 or 4000 items are considered in a basket. We may not know about all of them and we need not know all of them. But we have to understand that in a basket of goods, there are many items which are considered. So the price average for certain quantity of all these goods in the USA is, let's say, 100 US dollars. Now let's consider the same basket of goods in India also. The same basket of goods cost 2500 rupees in India. This means that 100 US dollars is equivalent to 2500 INR. So 100 USD is equal to 2500 INR. This means that 1 USD is equal to 25 INR in terms of purchasing power parity exchange rates. So purchasing power parity is nothing but a metric where exchange rate between two countries is determined on a basis of specific basket of goods. For example, basket like this. There are many items in this basket. We will consider the same basket in India and other country which we are comparing, and we will see whatever is the basket price that is costing in both the countries, and we will simply equate both the values in different currencies and we will make a comparison. This is purchasing power parity. Purchasing power parity is based on law of one price. Law of one price simply states that because of globalization and non-importance of physical boundaries of countries, any good or service for that matter should cost equal in all countries. This is called as law of one price. So one price should exist in all countries irrespective of where they are located. This is law of one price. Purchasing power parity is used to compare purchasing power of two currencies. As we have seen, purchasing power of $1 is nothing but 25 INR. World Bank calculates GDP purchasing power parity of countries in its International Comparison Program. International Comparison Program is a partnership program between World Bank, IMF, UN, OECD, ABD, this is Asian Development Bank, ADB, and others. In terms of purchasing power parity, India is the world's third largest economy. Roughly, I think it is around 12 trillion US dollars. So the first one is China, second is USA. GDP purchasing power parity is used by IMF for ranking global economies. India is world's third largest economy in terms of GDP PPP. Let's follow up in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.